Welcome to the How of Business with your host, Henry Lopez, the podcast that helps you start, run, and grow your small business. And now, here is your host.
Welcome to the How of Business podcast. This is Henry Lopez, and this is part 3 of a Roundtable series on entrepreneurship and business ownership. In part 1, we discussed how to find the right business, and in part 2, we focused on growing your business. Now here in part 3, we explore what every business owner should think about much earlier than they usually do, which is how do you plan to exit your business? Joining me again on this third episode is Giuseppe Grammatico, the franchise guide, Rocky Lalvani of the Profit Answer Man podcast, and David Barnett, a business acquisition expert and author. In this episode, we discuss business valuation, systems and processes, owner dependency, deal structures, and overall exit planning, and what really makes a business sellable. We also explore the emotional side of selling a business and why planning your exit should begin much earlier than most entrepreneurs realize. So here is part 3, selling a business.
Okay, and we're back. We're talking about the 3 phases of entrepreneurship. We talked about and covered the first 2 phases, and that's finding your right business. Then we got that business up and running. We talked quite a bit about technology and AI. And now in the final phase, our third phase and third show in the series, we're going to be talking about selling the business. I've talked quite a bit with David on this topic. It's actually our number 1 downloaded show. How do I sell my business? And that seems to be coming up quite a bit. And we talked about lots of different areas. And the one key thing I will mention, and this is something that I did personally and that I recommend to everyone, is that you think about selling your business immediately. You don't think about selling your business, and this is the recommendation I make to everyone based off of your plans for the business. So what do I mean by that? When I invested in my first franchise back in February 2nd of 2007, once I signed the franchise agreement, I asked the franchisor and I said, how do I sell my business? And he looked at me almost kind of regretting his decision of approving me. And he's like, well, why are you asking how to sell your business? And I said, well, this is the time you start, right? I don't want to wait until year 10 and say, okay, now I want to sell my business. What do I have to do? How do I build a business that works without me so that I can have it automated? I can have those systems in place so that I can get the highest valuation. I think a lot of individuals feel that a buyer is simply looking at the financials, and that is simply not the case. You can have a business cash flowing or generating, we'll call it seller discretionary earnings of, we'll call it 250,000, and that owner is expecting to get a 4x multiple $1 million sales price while still working in the business 90 to 100 hours a week. And that's really not what another buyer is looking for. They're looking for the cash flow, but they are not looking.
You wouldn't pay $1 million to live that life?
To work 100 hours a week? Why not? So it seems like common sense, but I simply made the same mistakes as well when I got my first offer and realized, wait a second, they're giving me my multiple, but they're giving me my multiple on a completely different number. So although I was preparing, it was a rude awakening, and I had to learn things the hard way initially when I had first listed or started asking around of what the business is worth. So you really have to factor in your involvement in the business, right? You want to look at length of time. We want to look for growth. Growth is also going to be big, but also just the overall involvement. I'll let David kind of take it from here. But what are things do you recommend people start initially, and what are some of the major things people should be aware of and preparing for almost day one when launching either a brand new franchise or purchasing a resale business?
So you mentioned cash flow. Cash flow determines price. So if you want a higher price for your business, it needs to make more money. That's always the first question buyers ask is, how much money does it make? The second question is actually probably more important. And the second question is, will the cash flow continue under my stewardship? And that's when they start to examine questions like, how involved is the owner? Are the systems and processes in place? Many of the things that you just came to mention, actually. And so that answer to the second question will determine whether they want to do a deal at all, or it will determine what kind of terms are going to be put on the price that is offered. So if there's a huge amount of concentration and responsibility in the hands of the seller, A buyer might think, hey, I'm going to need this person to stick around for 2 years to teach me everything because there's nothing organized or put into place. And so in that case, I need to have some kind of deal with them where they don't get all the money until I've gotten all the training. And so the seller could end up with a deal that has the price they want, but not the terms that they want. And they could end up stuck to that business for years afterwards because it's not really ready to transfer. The other big thing I like to point out to people is that 80% of businesses listed on the big business for sale websites do not sell. And this is a big shock for people because most business owners think, I own a business, it makes money, someone's going to want to buy it. Whenever I want to sell it, I'll just put it up for sale. And the reality is it's tough to sell a business because at its essence, a business is a system where people interact with equipment, machinery, capital, inventory, et cetera, and they perform processes to help make the customer happy. And that's supposed to create a positive cash flow. And so what you are selling when you're selling a business is you're selling this orchestration of human activity. And if you mess it up at all, then the thing falls apart and it doesn't make any money. So the businesses are fragile, is the point I'm trying to make. And so a lot of businesses don't sell. I do think that it's important for people to have an exit plan. And in order to really have an exit plan, you have to know what you've got. So this is why I often say to people, they need to have an evaluation done of what the business would be worth, what it would sell for, what the realistic terms of sale would be, so that they know if they actually have a saleable business or not. And if they don't, it doesn't necessarily, and like, you're not going to believe me when I say this. You're not going to believe that I'm the one saying this. If you don't have a sellable business, it doesn't necessarily mean you need to make it one, because there are plenty of people who do something every day that delivers value and they earn good money. And from point A to point B to actually make it into a saleable business could be a decade of work and require huge amounts of growth and training other people and growing layers of supervision within the business, and would involve a lot of risk. And what might make more sense for that person is try to figure out a way to earn an extra 50 grand a year and just do that for the next 10 years. And they'll end up with the money they would have gotten in the sale anyway. But here's the issue is most people are never in a position to actually make an educated, informed decision about which exit plan is correct because they never do the analysis work. They never stop and think about what they have. Is it saleable? Under what conditions would it sell for? And unfortunately, most of the people that I deal with are not planning 10 years in advance. I do have some clients like that. They come to me, they want to do an evaluation. They come back every second year. We update it. They use it like a scorecard to figure out where they're at. But most people that come to me because some pressing personal thing has erupted in their life that causes them to no longer be able to run the business, which is unfortunate. But this is what leads to the stat from the big websites where 80% of listed businesses don't sell.
I think the biggest thing in selling a business, and it's the thing that we don't put a value on, it's trust. How do I trust what I'm buying is really what I think I'm buying? So, David, what you're talking about, I want to see years of financials, not 6 months, right? We want to see a couple of years of proven financials. Well, you can't have a couple of years of proven financials if you haven't been taking care of them. It's also what I love about Profit First, as we talked about before, you can prove by looking at bank statements, here's the money that came in. You can see every single deposit. It's all came in the same place. You can see the money I took for owner's pay. You can see the profit. You can see what I'm actually spending on the business. And so I think that gives a bit more trust to people to say, oh, this is real. I can see the cash flowing through the business. When it all goes in and out of one bank account, I think it gets murky. It's hard to tell what's what. So it makes it easier for people to understand, because what we'll do, the owner's pay account might include the car payment because I wanted a nice car in the business, right? And say, that was for my benefit. You don't need that. But you don't remember all that stuff 3 years later. But when it's put into buckets, I think it makes it a lot easier for people to understand. The second thing is, who's doing the financials? Your spouse or a CPA firm? All right. I know we made fun of the CPA firms before, but the point being, there's a professional doing the books that is separate from you. And so that brings a little bit more trust to the situation. And so those are the big things, I think, is how do you really prove that what you say is the reality?
Yeah, so great points. And of course, obvious points here as you started the conversation, Giuseppe, on cash flow is the key thing. That's obvious, although I am surprised, maybe I shouldn't be surprised anymore, of how I will talk to people after the fact that they've bought a business for other reasons and it's not profitable, right? And how people are able to sell businesses that are not profitable. But I'll throw in then the non-financial component, which we all, I think, will agree on, is the systems need to place. I think David spoke to it. The systems need to be in place. I can tell you as an example, well, I think back to one of the key businesses that I sold. It was a business that I bought. It was a salon suite business, 2 locations, owned it for 6 years and then sold it. And one of the key reasons we had multiple offers, obviously it was making money. That was a given. But and it had history, to your point, Rocky, right? 10 years of history at that point that I could show. Leases in place, tenants in place, high occupancy, all of those obvious things. But they all mentioned that everything was documented, that they could come in day one. And the business model, of course, is a very much an absentee owner type of business model anyway. But everything was documented from the front desk in that model. In our interpretation of it, we had a receptionist. And of course, we had the back office function. Everything was documented. And that was a big selling point.
Absolutely. You need all that documentation.
This is what gives franchises a leg up for resale.
Agreed.
Because a franchise has all the SOPs, documentation, and the buyer isn't necessarily also relying on the seller to train them how to run it, because the franchisor training infrastructure is there as well. And it's interesting because when franchises are run well and are profitable, they usually never go on the market.
Correct.
They're usually acquired by like the neighboring franchisee guy.
Yeah.
Territory
or a big tranche of 10 locations or 15 locations or 20 locations. Yep.
Yep. And they rarely get out there, on those websites to be advertised for sale. Now, the ones that are not performing is a different story.
That's right.
There may not be a neighboring territory or area, but yeah, absolutely. When people ask me, have you seen resales? And I said, well, once you become a franchisee, you essentially get first dibs. You're going to sell to your neighbor. There's going to be fewer closing costs and commissions. And I'm all for that. If you find the right system and you want to grow and not have to go through retraining, I always say, if you are buying a franchise or a listing and it's a resale, you're still getting approved from the franchisor who is going to be training you, but they also want to make sure you have a real good understanding of the actual system itself. But there are various ways, which kind of brings me to going back to what I had mentioned before and working, 100 hours a week and trying to sell this business. So, how do you make yourself obsolete in the business? So one of the things I personally did was I had hired a general manager. Now I was in my mid to 26, 27 years old, hired a general manager. And the mistake I made was that manager had to get approval from me. So big decisions, crediting a customer, canceling a customer, making a change in the subcontractor, whatever the case may be, he had to get approval. Looking back, that was really silly, since that general manager had a lot more experience than I did in that specific industry. But finding that right person to kind of manage the day-to-day, freeing my time up so I can work a little bit more on the business and not have to hear every single issue or complain or call out. It was almost like a buffer. And what I recommend I work with a lot of individuals that are going to try and keep their job and run a semi-passive franchise, is getting on the same page of that manager. So I think, part of making yourself obsolete is finding that, first off, the right business and systems, but also finding that key employee, whether it be a manager or just an empowered employee, as I call it. Rocky, wanted to get your thoughts on, how to truly make yourself obsolete so that you're not putting in the 100 hours. And now that buyer coming in is kind of discounting the hours you're putting in and beating up your evaluation.
So that's a mindset of letting go, right? Understanding that somebody else can do something. Maybe they can't do it as well as you, but they can do it. The example I like to use is McDonald's built an entire business model on having 16-year-olds run their restaurant, including manage them. How did they do that? They built systems, processes, and a way of doing all of that stuff. And it's consistent wherever you go. Yet I find most business owners, it's like they are allergic to that. They really struggle to say, I want to build a system and a process. My business is special. My business is this. There are parts of your business that are pretty routine, and you just have to figure out how to do that so that you aren't working 100 hours. I mean, why you didn't leave a 40-hour job to work 80 hours for half as much? So,
well, to just to expand on that sort of 100-hour work week thing that we keep mentioning here lately, I will often see when I'm working with someone looking to buy a business, we'll see what I'll call an abnormally profitable business. So again, getting back to benchmarking data, and we'll look at a business, we'll be like, wow, this business is really profitable. It's really hard for a business to earn that amount of money. And then when the buyer and seller get to know each other a little bit better, and there's some experience there, like if they go out to lunch and the owner's phone doesn't stop ringing because people keep calling them, or they meet in the evening and the seller's phone is still ringing all the time, 7, 8 o'clock at night. And you begin to realize, okay, the reason this person is so profitable is because they're actually doing 2 jobs. There should be another person on the payroll here so that this person can work a regular work week. And to your point, Giuseppe, you said, buyers discount your hours. This is what happens is they go, okay, there's a person missing from payroll. The business is not as profitable as it appears. I'm going to have to hire somebody else because I'm not going to work 90 or 100 hours a week when I become the owner of this business.
Great points. This is that free labor that often, I've been guilty of it, that business owners will put in can hide a broken business model, as we've talked about before. And so that's a key. But going back also then to Rocky's point, doing the comparison of McDonald's, I hear the same thing. Rocky said, well, my business is much more complicated. Well, first of all, probably not. You think it is, but probably not. But if it is, how complicated is it of your making? And if it truly is such a customized or highly engineered product that you are delivering or service, then I would say to you that that's not probably going to scale, right? It's going to be hard to scale those kinds of businesses. There are exceptions, but that's something to look for. Or are you making it complicated because it's your identity? It feeds your ego to be the only one that can do it just right. And I think we've all have seen examples of this. For example, it comes to mind somebody I spoke to at some point. He was doing HVAC repair, and his attitude was only he was the best technician out there. And that may well be true to both Rocky and David and Giuseppe's point, but he's missing the point. My dad was a victim of this. My dad was a fine carpenter, worked on high-end yachts, but he could never go beyond being a solo entrepreneur because his level of perfectionism may have rubbed off on me, was so obsessive that no one else could ever do it to his level. And therefore he died as a solo entrepreneur, making decent money, but he never could scale the business. So I think that those are key things we have to look at. Not only does it impact, of course, the sellability of a business, because immediately, if I'm looking at a business like that, I'm saying, well, we'll never be able to do that. And I'm not going to hire you and keep you for the next 10 years. So I think those are components that add on to what you guys are sharing.
The final piece here is how do we structure the deal, right? And what's that kind of that emotional transition after selling the business? And I've talked to so many people when it comes to, okay, yes, they're giving me my ask of $1 million for the business, but now, in the fine print or in the agreement, they only want to give me half up front, and then the other half is over 3 years, and they want to link it to if there's going to be cancellations or not. And I've seen quite a few structures. This is definitely, I wouldn't say my strongest area, and I would lean on you guys for kind of deal structuring. So I'll maybe have David kick off. What is the optimal setup? And, as far as the deal structure, something that is fair. And I guess it also maybe depends, and I'll let you answer this, but why you're selling the business, right? If you're selling, obviously, if it's something, you're going through a divorce or, that's going to be a different sell. But if this is the legacy and you're looking at, that retirement, talk us through kind of different structures and any types of recommendations.
So every seller who ever sells a business wants to get a check on closing day. I've never met one who didn't. So that's the starting point. Mm-hmm. Because we've been talking throughout these 3 different conversations about all the potential problems that a buyer might see in a business: lack of systems, owner dependency, concentration with one supplier, tax returns and financials that don't match, problems with clarity in the financial statements, owners that work 100 hours a week. Like, all of these things cause the buyer to have doubts and concerns, and doubts and concerns equals risk. And so basically, as a seller, there's two choices. If you insist on getting a check on closing day and you have to be paid in full, then what the buyer is going to do is the buyer is going to try to figure out what all of those different concerns of theirs are worth, and they're going to discount your price. So instead of getting the $1 million that you want, you might have to accept less than half, because that discount is what the buyer needs to be comfortable with all those risks. However, if you do still want to get $1 million, you probably can negotiate it if you share the risk with the buyer. And so this is where you get into these different structures where the buyer might say, well, I'll give you a down payment of this amount, and I want you to hold a seller financing note, and I'll pay you over several years. Or maybe I'll pay you this amount, but if these numbers are achieved, then there'll be this bonus payment after 4 years. And basically, there's 101 different varieties of how you can structure these things. But it all comes down to the same thing. It's all about managing the perceived risk that the buyer sees, because the business is not buttoned up tight with a bow on top, everything done perfectly. Because when they are buttoned up tight with a bow on top and everything's taken care of perfectly, buyers come along and write a check because they have absolute confidence in what they're getting.
Yeah, it's so well said. I've seen that so many times. And so I think what happens there in those cases, David, with those people, those situations where you have a business that you're selling that doesn't have all of those things, is sometimes those sellers need a little bit of time in the shock of reality that, oh, I didn't get multiple offers that I wanted, all cash. Like you said, some of them exit. It's like it happens in real estate, right? Somebody has this inflated idea of what their home is worth, and then they don't get it, and so they take it personally, take the house off the market. But it's such an interesting dynamic. But I want to speak to for a moment, and then I'll pass it to Rocky, about the whole selling mindset and the identity challenges that come with this. But I always say there's two hardest decisions a business owner has to make. One is, when do I shut down a business that's not working? And that's the harder of the two. Yeah, very hard decision to make. Instead, if we're able to, we keep it afloat and we keep inputting money and we accept not making any money. And the second hardest is selling a business. And it's interesting, having done both and having advised people, it's interesting how the advice you'll get, again, from the attorney or the CPA, who are not business owners at the same level, so, whoa, how are you going to replace that income? My philosophy, and this is just my philosophy, is that everything is always for sale. And we won't get personal about that, but every business is always for sale, in my opinion. Because the thing I always tell people when they're thinking, well, should I keep the business and keep making that money, is that we don't know what the risk is that might hit us 2 years from now that might completely change my ability to continue making that money. So I always look at it as, if I can take that off the table and the timing is right, then I take that opportunity. But that's just my mindset. You were talking about back when you started your business, Giuseppe, and talking about exit planning. I think that's a more recent thing. I don't think 10 years ago people were as focused or even knew this term exit planning, right? At least that'd be interesting what you guys think. But now we think about those things, and rightly so.
So we always like to say, begin with the end in mind. And what everyone forgets about until April 15th is the tax bill on the sale. And depending on how the deal is structured, your tax bill is dramatically different. And it really just depends on what they're buying and how they're buying it. I can assure you that a smart buyer is setting it up for their benefit. And so they want to make sure that they get the best situation from a tax standpoint. They also want the best situation from a liability standpoint. So if I'm buying a C Corp, I'm buying stock in that C Corp, I now own all the liability of the last however many years that company has been in business, including the current year tax liabilities. So these are all the things that you have to be aware of from that standpoint. What are the tax implications of how it's being done? And that also, if real estate's involved, how are those separated, and how are the two transactions happening? What does that look like? The other side of this is, can I afford to sell? So I know a lot of business owners, they're like, I want to sell. Well, how much money do you have for retirement? Because your business is generating 250,000 and you're going to sell it for $1 million, woohoo. But $1 million, if you just use the 4% rule, which is a retirement rule, says you're going to get $40,000 in income for the rest of your life from that $1 million. But you were making 250. How are you going to cover the other $210,000? What's gonna, and that's really where business owners are like, oh, I really have to think this through a lot more. More often than not in those situations, they decide not to sell. They decide to put a manager in. Mm-hmm. So I could still pay a manager $125, and I could still make $125, and I still have a business.
I think that was a great point. I think that was in part what you were speaking to initially on this point, Giuseppe, right?
Yes. Yep. Absolutely. Yep.
Comes to that same sweet salon business that I referred to. There were two reasons I decided to sell. One was a partnership challenge. And second was I saw the competitive landscape changing. And I knew that I was going to end up behind the curve there without significant investment. And the other thing is, though, that's so hard is when you sell, it is the right decision. You made that decision. If you look back and try to second guess it, boy, it's going to be a lot of sleepless nights. But great point, I think, on why sometimes you need to sell, even if it might not necessarily be that you have to do something else to cover the income gap. We've shared a lot of positives and negatives and challenges and benefits. I want to make sure that I ended at least, and I think Rocky and David and you will agree, Giuseppe, I love being a business owner. As Rocky said, I can't imagine, if I need to, I will, but I can't imagine working for somebody else again. So while it has its challenges and you have to have the right mindset, and we've shared here in these 3 conversations kind of what it takes to get in, to get out, to manage it well, to make it profitable. It's the best thing I ever did in my life. And it's so rewarding, not just from a financial perspective, although it's got to be there, but just in the freedoms that it has given me and in my life. And having worked in the corporate world for many, many years, I can compare it and contrast it, right? If you have the right opportunity and you're in the right position in life and you're taking the right level of risk, there are no guarantees, but boy, what an opportunity it is to be able to be a business owner.
Yeah, I there's all kinds of wise things people say about people that reach the end of their life and the things that they may regret. And I'm so happy that I took the leap, and I took the leap a couple times because I jumped back and forth across the fence a few times over the course of my adult life. So I was an employee, then I owned my own business, and then I ended up being an employee again because the business didn't work out, and then I ended up back in being in business for myself again. And I don't think there's anything wrong with that. It's a journey of personal growth. And, we mentioned earlier, I think in the first chapter of this conversation, someone used the bankrupt comment in reference to something. When I had my business brokerage office open, we used to have an intake form for people that wanted to sell their business. And most of these people had successful businesses with good profitability. And that's why I wanted to list them for sale. And one of the questions on the intake form was, have you ever declared business or personal bankruptcy? Almost a third of them checked yes. And when I asked the question, it always was some version of this story. Yes, I was young, I was inexperienced, I got into something I didn't understand, I went too far, I over-leveraged, I borrowed too much, and boom, the bad things happened. And then I used those experiences to build the business I own today. And it just kind of highlighted the fact that you can get into trouble with business, absolutely. You are going to learn. If you are open to learning, then you can make this into a successful path. And if you're open to learning from other people's advice and other people's experience, then you'll probably do even better.
Just remember one thing. The purpose of business is to make money. Everything else is solvable once you make money. But you have to make money. And I think too often business owners forget that.
I always say bet on yourself or you're going to regret it. Explore it. That doesn't mean you should own and move forward with the business, but you owe it to yourself.
Thank you for listening to The How of Business. For more information about our coaching programs, online courses, show notes pages, links, and other resources, please visit thehowofbusiness.com.